Hello everyone and welcome to Jane's retirement account video for March 2024. I do apologize that the previous video that was uploaded was missing sound. I will get this uploaded. I had clicked the wrong microphone function. I believe I'd clicked on the webcam that I don't currently have active and did not notice as I was recording that there was no sound. So I apologize for that. We'll get the new one uploaded and go from there. Also, I apologize because my wife and I recently got stomach flu from likely our 7-month-old child, and that was probably the sickest that I've been in about 2 decades. So it's been a fun last few months for us, and as you can tell, it's prevented me from getting caught up as much as I would have preferred or liked to. But without further ado, let's look at our numbers, and this is just as a reminder, this is going through the quicker format where I've got less production stuff involved, even though I know production's pretty minimal already, so that way I can just get you guys to the numbers and have the discussion, but hopefully shorten the length of the video. So as always, I'm not a financial advisor, don't claim to be one. Videos based on my personal views and does not reflect the opinions or views of my employer. I do hold a number of positions in common with Jane. I have those listed on the screen. And then it's a real portfolio with real shares being traded. It is not a practice portfolio or a play portfolio or a fake portfolio that someone, created, through a fake trading website. So that is why I include as many screenshots as I can to show the validity of it. And the why I do this, it all goes back to John and Jane being taken advantage of by their financial advisor, who, in my opinion, really wasn't doing what he was supposed to be doing. And John and Jane personally felt like he wasn't doing what he was supposed to be doing either. So in terms of what they were being charged with fees and the way that it was handled when they changed from one brokerage to another brokerage and they moved some mutual funds over, that was what really triggered John and Jane to decide that they wanted to take advantage of handle their own finances. And that's where basically I came into play. That when they asked me about it, I just mentioned that I'd be glad to help. I don't want to be paid. I just want to basically be able to talk about things anonymously, so that way anyone else that's in a similar position or would like to take control of their own finances, that maybe they don't have someone like me to talk to, that hopefully we can give them some of the certainty or at least some of the information that they need so that they can do things on their own if they want to. And that's really what this all stems from. And with their background, so John retired in March 2018, Jane retired in 2021. Both of them collect Social Security as their primary source of income. And then John currently withdraws $1,106.17 a month from his traditional IRA, and Jane does not currently collect anything from hers. John and Jane also collect $1,700 a month from the taxable account, but that originally started off at $1,000, and all of the withdrawals that are made from both the traditional IRA and the taxable account are covered by cash flow. So basically the dividends and the interest income that flow into those, and that is a primary hallmark of the type of investing, or at least the type of plan that John and Jane subscribe to, is that the goal is to not have to take any more money than the cash flow created, because that is the best, or at least the most conservative way to create a long-term retirement cash flow where you're not necessarily drawing down the principal of your investment using something like the 4% rule. The 4% rule is probably the most common one that's out there. They do have other investments outside of what I help them with, and those are going to be things like certificates, low risk bonds, different things like that. And they have no debt or monthly payments, so they make my job incredibly easy because John and Jane can live off of basically the bare minimum if they want to. And that's because they've been very prudent with their finances. So an important detail to note. So in their account, they did see a couple of increases. In this case, in Jane's account. So with Eaton, there was the 9.3% increase. Main Street Capital, there was the special dividend or a supplemental dividend of 30 cents a share. And then in 3M, in the month of March, there was a 0.7% increase. And then the Blue Owl Capital, they also had a supplemental dividend, but it was for 8 cents a share. And then with Williams Companies, that was a 6.1% increase in that for that company. Went backwards. And then for the Roth IRA, Nextera Energy increased it by 10.2%, and then T. Rowe Price was a 1.6% increase. And again, this is all for the month of March. So for the trades here, just want to point out with EOG, sold off the high cost shares, and you'll see that in the upcoming slide. And yeah, pretty straightforward on this one. And then for the Roth IRA, very similar situation here. But with CME, we're establishing the position here. It was mentioned previously that we were looking at adding a CME group. We're looking at adding more shares. We do have some limit trades at about $205, and I believe another one right now that's set for $200 per share. Hasn't been triggered yet, but definitely looking at adding in the low 200s. And then for American Tower Corporation, this is going to be a good one to reference the video looking at AMT for the high cost basis and the reduction that we do when it comes to selling off high cost shares in order to reduce the high cost position, which lowers our overall cost basis on those shares. And in the case of AMT, when I walk you through that video, it looks at, at one point there were shares that were owned that were, I believe, if I'm not mistaken, about $255 a share. And so those had been trimmed down, and the original cost basis on the original established position, I want to say, was as high as about $220 a share. That is now sitting at closer to, I want to say, in the ballpark of about $185 a share. So the thing is that over time, they're really the realized losses when you watch that video show that there's a pretty minimal realized loss that comes from it, and then we just continue to add more shares, in this case in the low $180 $170 share range. But anyway, so just if you're interested, I would encourage you to go watch that video because it actually gives more detail about the history of those transactions over the course of about three and a half years. But in this case, this was the higher cost shares that were still in the portfolio, and it was sold off. And as you well know right now, AMT's share price is in the lower $180 share range, and that's we're talking about nearly $25 difference between what we sold shares at here to where it is now. So trimming that back at that time has ultimately been extremely effective for reducing the cost basis, and what would be our exposure, or I should say Jane's exposure, to American Tower, high cost or shares that are overvalued. And for the realized gain loss, so with EOG, $1.18 here. Again, high cost shares. You can tell that we trimmed them based on the fact that there was only $1.18 gain. Shares are much higher now. I would look at adding more shares of EOG if we saw it pull back some, but not anything that we're looking to necessarily grow the position of at today's current prices. And then with AMT here, even though the gain was $80 on the 5 shares, that works out to be, what, $19-ish a share. Sorry, math right now isn't going to be my thing. But still, mostly these were just the high-cost shares that we took a little bit of a gain on. If you look at the year-to-date traditional IRA and then the Roth IRA gain loss, you can see that essentially the way I look at this is that about in the traditional IRA, 87.8 cents of every dollar of shares traded has resulted in a gain, and then 12.16 cents of every dollar of trades resulted in a loss. That's just a general idea of how we look at that, because we have the total cost basis and then the total proceeds. So in this case, there's been a overall net gain of $1,536.44. Something I haven't really talked a ton about, but just kind of became a little bit apparent to me as I was just talking about this, is that once you take these gains too, these are gains that are removed off the table. So when you're looking at the unrealized gains in Jane's portfolio or the unrealized loss, also remember that if we go back in the previous years and look at the gains that have been taken off the table, that sometimes an unrealized loss can look in a portfolio can make it look like, man, maybe that portfolio hasn't performed as well. Well, it also depends on how many gains you've taken off the table, in the same way that it could also end up being how many losses you've taken off the table to make it look like maybe things are doing better than they really are. That's what I've talked about probably more often, versus the latter, being that maybe the portfolio looks like it hasn't performed as well as it could have. So anyway, hopefully that makes sense. Let me know if you have any questions in the comments on it. And then with the Roth IRA, that was closer to about 57 cents a share of every dollar worth of trades has resulted in a gain, whereas about 43% or 43 cents of every dollar of trades has resulted in a loss in terms of the gains, but still resulted in a net gain. And then that is it for that slide. And I apologize, it is reloading since I previously did this but forgot to do sound with it. So in here, basically looking at 2023 versus 2024, and you can see that there's in some cases a little bit of a timing issue when we look at these, but most of these positions have either been reduced in size, like we reduced here Cummins, we reduced the size of Digital Realty, But then we've also had the ones that we've increased in size, like with Enbridge, and also seen the dividend increases from it, reduce the size of Eaton. That's a good example of one where actually we took those gains off the table, and just reduced the size of the position, but reinvested the funds into something that was yielding a little bit higher. Sorry there. I'll promise I'll get better at this. And then with Lyondell Basel, reduce the size of the position. But general theme, either we've seen the dividend increase or dividends grow, likely due to increases. We've seen the dividends decrease, likely due to the reduction in the position. And for things like Lyondell Basel, that's going to be one where we're doing the same thing that I was just talking about with American Tower. We were reducing the cost basis or the high cost shares of that position. And so, yeah, the dividend income went down, but now our cost basis is sitting in the, I believe it's the high $80 a share range, whereas before it was sitting in the upper $90 a share range. But what we were able to do was with the proceeds, we're able to use the Charles Schwab money market and then the CD income in order to actually compensate enough for the reduction in the stocks that were previously held here, in order to make up the income, to actually grow how much income was received in the traditional IRA for the month of March as compared to March of 2023. And then for the Roth IRA, little bit different story here. We doubled the size essentially of the position with ADC. And then with Bank of America, we did recently actually reduce the size of this position, but we were able to collect one last round of dividends before doing that. And then with BP, we saw the increase there. Main Street Capital, we saw the increase there. With NextEra Energy, we had, compared to last year, we've increased the size of that position, although we've started decreasing it. With the recent run up in the price, we've sold off a few shares, and that was going to be early in the month of May. But ultimately, with the shares no longer held in the month of March for 2023, that is going to be some of the higher yield shares. I believe it was some preferred series shares that we ended up trimming back. Rhythm Capital, preferred series D, if I'm not mistaken, was one of those. But basically, even with the loss of the $162.49 there, we were able to make up for that by taking those funds, moving them into the Charles Schwab money market, CD income, but also investing more into RNP. That one's grown also pretty substantially as well. But you can see that the Roth IRA income year over year increased pretty substantially in the Roth IRA. And then when we look at our year over year comparisons here, so again, we have $2,579.59 as compared to $2,508.07. And then this is our conservative forecast, the negative 16.3%. This basically is looking at the income without the added benefit of what we expect to get or are hoping to get from Charles Schwab money market and certificates of deposit. So just know that although, yes, it says negative 16.3%, this number will continue to trend towards the positive. And then also we have the the more realistic number at the end that I'll show you that is going to factor in what we estimate we're going to be receiving from the certificates of deposit, Charles Schwab money market, And that's especially important to the traditional IRA because it makes up a very substantial portion of the traditional IRA income. And then with the Roth IRA, the $976.58 as compared to the $741.85 year over year. This is sitting at a positive, but this is still the conservative number. But just remember that in the Roth IRA, less of the income is dependent currently on Charles Schwab money market funds and then certificates of deposit, which is part of the reason why it's not showing negative, or at least showing, not as upside down as what the traditional IRAs was. And then in the month-end balance, this was a pretty positive one to see here. So it ended with a $463,000 balance as compared to a $420,000 balance. So the balance in the Jane's traditional IRA actually is higher currently, or at least at the end of March, than it was at any point in 2023. Jane is not currently, just as a reminder, not taking any withdrawals from her account, so everything's been reinvested. But still a very encouraging sign to see it reach a new high, even in what is considered to be kind of a tumultuous market. And then with the Roth IRA, that's going to be $214,000. That is also a high as compared to what was seen in 2023. And I also like to look at the average balances down here. In this case, so far for the year, we're at averaging $209,000 in the Roth IRA and averaging about $452,000 in the traditional IRA as compared to the full year averages here. So I like to see that that's trending up as well. And then when we look at the 7-year history here, so this is looking at the dividends received for the full 7 years on the account, and dividends, interest income, CD income, you name it. But it's, while the increase year over year might look very substantial in the beginning, with the traditional IRA, it has actually always been over 10% during this time. One of the things I think is important to note is that there hasn't been any contributions into this account since Jane retired from 2021. So that would have been in taxable in the year 2022. The contribution that was made was a traditional IRA contribution, but since then there hasn't been any money placed into the traditional IRA. So it's not like there's been a large infusion of money that's made it easy to distort these year over year increases and saying, oh, look at how much the income went up, because, maybe $50,000 got put in the account, which we all know can't happen except from like a rollover from a 401k or something like that. But Jane, since about 2020, has just been doing her normal contributions plus the catch-up contributions. So she's only been able to add, at any point, I believe it was 6,500 or something like 6,500 and then 7,000. So she's only been able to add the maximum amount as allowed by the IRS. There's no 401ks that Jane has, or any other outside sources that she's been able to roll over into this to somehow distort these numbers to make it look like they're growing faster than they really are. And then with the Roth IRA, been a little bit more staggered in its growth, more ebbs and flows, particularly around COVID. But the general idea here is that you can see on average that the income has continued to grow every year that's been produced by this account. And even though in 2018 this represents a partial year, where, not all funds were invested and things were being changed over, at the time that this process started. It is still nice to see that the steady income has continued to grow since then, and is now more than double what it was. And I expect that this number will probably be closer to about $1,900 for the year. And then this number will probably end up being closer to $900 for the year. So you can easily say, even with 2019, once most things were fully invested, we're talking about income that's nearly double over the course of the last 6 years, if you use 2019 as the actual starting point. And then for the cash balances, I like to show this because cash balances are not something that get talked about a whole lot. Cash on hand either can be invested into things like money market or into CDs. But basically, you also need to have cash on hand in order to do some of the trading that we do, in order to buy low and then sell off high cost share basis. So just know that when you're looking at the cash balances here, this also directly correlates to the funds that are readily available for Jane to be able to draw if she needed to at any given time. So, for example, if she needed to make a withdrawal from her traditional IRA for some emergency reason, if she was able to go in and in the month of March, she could draw $19,000 before we would have to actually say, okay, do we need to sell an investment in order to come up with those funds? This is part of the reason why cash flow is so important with investing. Because the idea is that you don't want to have to sell an investment in order to generate the funds that you need to survive. So when you see the $19,350 here, what it's also saying is that if Jane was just taking a regular withdrawal out of the account of $2,000 a month, how many months could she sustain this for, or how many trades could I engage in? But basically, cash balance is going to increase or decrease based on how attractive things are looking at the time. So usually when there's more cash on hand, that's when things are either looking overvalued or we're fully vested. But then when the cash on hand starts to get on the lower side, that I think is a good example would be like in 2020 and 2021, where basically during COVID, things became attractively priced. We utilized those funds to invest. And so, anyway, I'm kind of rambling a little bit. I apologize. But with the Roth IRA, with the traditional IRA, what I like to look at is what is the average cash on hand. And so far for the year, it's sitting at about 28,000. You can kind of see how this has trended up. That's not by mistake. That is because as Jane gets closer to wanting to make withdrawals from her account, I consider it really important that she always has more cash on hand than less cash on hand, because at this point, investing and getting really big returns is not something that is of the utmost importance as compared to her being able to live comfortably in retirement and spend her money the way that she wants to be able to spend it. And then with the Roth IRA, you can see here that actually the cash on hand in 2023 was looking quite a bit stronger than what it is in 2024. One of the things that isn't represented by these numbers on here is going to be that the funds in the Charles Schwab money market and then the funds in the certificates of deposit are not represented in this cash balance. So in these numbers here, just know that if we add in those balances, these numbers would be substantially higher than what they're showing today, even though those are significantly more liquid than what the equity investments are. And then with the unrealized gains, so red just means that at the time that it was sitting at an unrealized loss. Black means it's sitting at an unrealized gain. You can see that there's been a pretty substantial improvement in the traditional IRA for 2024. It's sitting at about the same average as what 2020, all of 2023 was at. But off of the highs from 2021 and 2022. But this actually goes back to what I was saying about some of the gains being taken off of the table. Because if you go back and we look at the account balances, it's not so much that Jane lost all of this money. It's that we also took some of those gains off the table. So even though we have account balances that are sitting at all-time highs, just because the unrealized gain loss isn't sitting there either, just also means that we took some of those gains off the table. Realizing gains in a traditional IRA or a Roth IRA is not a taxable event. The taxable event occurs when money is drawn from that account. And so it's a lot more reasonable for Jane to actually do trades in her traditional IRA or her Roth IRA and take those gains off the table if it makes sense, as compared to, say, the taxable account. Because the taxable account, when you take those gains off the table, that is when the taxable event occurs. And that is another reason why when you look at the taxable account, why the unrealized gains are substantially higher than what you see in the traditional IRA or in the Roth IRA. And then here you can see that we're sitting at about just flat, but also with both of these accounts, you can see how bad it was during COVID, right? During when the market really went down. So the thing is, I like to show that this is the good, the bad and the ugly, as I like to call it. And then on our the more realistic forecasts for Jane's income, basically we can see here this 1.2% is what we expect to see growth-wise from Jane's traditional IRA. And then we're looking at about 14% that we'll potentially see from the Roth. One of the things I like about this forecast, which is not something I had last year, is that I can look at it and say what happened year-over-year growth in January, February, and then in March as well, for each of the traditional IRA and the Roth IRA. And so, the fact that we're able to see that, yep, it's continued to grow year-over-year. Again, the Roth IRA has grown much more substantially here, but I also add the table here where I go the 3%, 5%, and 7% increase. I mostly just put this on here as a placeholder so that I can see, okay, if we were looking at a 7% increase, we'd be closing in on almost $2,000 a month of income, but obviously 1.2% is substantially less than that. So I usually use 3% as the low end growth, 5% as the middle, and then 7% as the high end of growth when it comes to the income estimates. And then I'll just wrap it up real quick with the gain loss tables here. Something that I did recently change is that I have started marking in orange where the dividend increases happened at. That's actually going to make it easier for me next year to be able to look at the table and know when dividends are likely going to increase for those companies, assuming that they announce payouts on the same date So anyway, this is the most recent update. This was, I believe, on May 26th. Don't hold me to that. May 24th would have been the market closing date where these numbers came from. And then also you can see the CD income down here. One of the things that's slightly different that I don't normally show is that this is the table of the shares no longer held. And in this case, this is going to be any CD that equity that's been sold, so stock that's been sold, or it's going to include the CDs where the CD has expired and income has been received from it, but is no longer being received moving forward in the future. So anything in this upper table here is going to be only what is currently active in the account at the time that these numbers were pulled. One of the other things I had mentioned in the other video, now that I'm thinking about it, is that the income that you see here is going off the conservative number, or at least closer to the conservative number. Part of the reason for that is because you'll notice here that it says in the estimates for CDs here, this is only counting the income that has been received, and part of that is because some of those CDs expire partway through. And rather than going through and doing all of the extra work to figure that out, I figured I'd only count what we know we've collected. Whereas when it comes to the equities, we're able to forecast that out better because we know what quarter they're going to pay in. We know how often they pay. And so the equities that you see up here, these represent the numbers that are as close to or almost exact, I should say, year-to-date numbers, while the full year numbers, whereas the CDs down here reflect year-to-date numbers. So the income that's being produced in this account is going to be substantially more than the 19,521, and that is reflected here by this estimate screen. Okay, so that just means that we have a lot more months of certificate income that's expected to be coming in. And then with the Roth IRA here, same exact thing. Marked in orange is the dividend increases. Another thing too that you can kind of pay attention to is that I like to track what is the percentage of the account based on the size of the position in terms of the amount invested into it. And then what is the percentage of the income that that position produces. So a good example here would be ADC, so that's Agree Realty. It makes up, just over 10% of the Roth IRA. Which sounds like a lot, but the Roth IRA is substantially smaller, and with Agree Realty, other than preferred shares, there is no other holding in John or Jane's retirement or taxable portfolio of this position. So out of everything that they own, it's not 10.41%, it's just 10.41% of Jane's traditional, Roth IRA. But it makes up 11.6% of the income. So what you'll tend to notice, though, is that if we have a higher yielding stock, for example, do we have a good example of one on here? There's a higher yielding share. Typically, when I think of it, I'm thinking of something along the lines of like PTY here, which is a diversified fund, but is higher risk. You can see that it makes up 0.34% of the invested amount, but makes up 2.01% of the income and is a 10.3% yield. So what I like to do here is that when we have something that has that high of a yield, and it does represent a higher risk to the portfolio, we want it to be a smaller part of that smaller overall amount of the investment. The exception here, when you look at this screen, is that RNP makes up, nearly 15% of the account, but produces just over 26% of the income. But that is a diversified closed-end fund that invests in real estate investment trusts. So it's not the same level of risk, in my opinion, as what PTI or PTY is, as shown on the other screen. Yeah, and then we have the shares that we sold here. So with NYCB, closed out that position, and then with Essex Realty, we recently closed out that position, and that's something that's going to be discussed later. So. Sorry, still got lots of brain fog. Trying to get better, and gonna go visit my wife's family this weekend. So this is a very last minute thing. I just saw the comments, and so I wanted to make this video as fast as I could, because I'm sorry for not having sound on that. If you guys have any questions, let me know. Anyway, thanks for dealing with my rambling on it. I'm going to continue to get better at it, and I will talk to you guys next time. Let me know if there's anything in the meantime that I can address. Have a great night.